right? So every year, if you have a cash rent situation, I would say you should be thinking about renegotiating. Because, think about it, here's their environment. This fall, a cash rent that's based on $4 corn looks a lot different than cash rent based on $5 corn. You know, $1, and you're getting an average of 200 bushels, that's $200 difference in returns without any change in cost. And that's the environment we're in. The share rent arrangements automatically adjust for that. All right? The disadvantage you have is that you have to, you're involved in paying the cost often before the crop, and often you have to market the crop, which, again, if you don't like doing that, that's not a good thing either. Here's what we see for fixed cash rents. We usually see a fixed cash rent. It's usually paid in 1 or 2 installments. One in the spring, one in the fall. More and more of those are going to one payment up front in the spring. And there's a couple reasons for that. One is that you're not at risk for the second payment. And the second reason is because cash rent or interest has been really low, so whether the farmer pays it now or later hasn't been that critical to them. Typically 1 year in length, and we've seen more and more moves to 1 year length leases. And you're going to have to renegotiate that. Think about renegotiating that every year. And the difficulty in setting that cash rent, again, $4 versus $5 makes a big difference. And then there's often concerns with fertilizer and yield documentation. And I think Tim's going to talk more about these as well, so he'll get more into the details. But that's my perspective is you got a trade-off there. And if you're in a share rent situation and you've heard about people moving to cash rents and you're thinking, well, maybe that's what I should be doing, you've been fine. I mean, you've captured that returns that have existed. All right, so there is variable cash rents. And here's, we have a variable cash rent on our Farm Doc website. What a variable cash rent typically does is sets a minimum cash rent. And it's very critical that you set a minimum cash rent because you generally want these rents to not be eligible for FSA payments. Because if you don't set a minimum, from a Farm Service Agency standpoint, you should be getting some of the government proceeds, which generally you want to avoid. So you set a minimum cash rent, and you set a revenue level, and if revenue goes above that, the landowner gets a % share of the return. And maybe that's a $250 minimum, and the cash rent is, or the revenue is $600. And if we have revenues above $600, the landlord gets 33% of them, or some percentage. The issue that you have with variable cash rents is one, setting them up. Where should the minimum and those other levels be? And you also have to figure out how you're going to measure revenue. Yields from the farm and what prices you're going to use. Most people that I see using variable cash leases use yields from the farm, and they would have to trust the farmer to provide those yields. And then they take prices from a place where they're going to deliver it to, and take an average of those prices every Wednesday for April to December or October. Average those, and that's the price that you use to determine that revenue. I'm almost done here. The other question that I get a lot is, have we reached a peak in farmland prices? And should I be concerned about that? And I'm going to just tell you what I think. Here's Illinois prices. This is the average across the state. You can see what prices have done. Across the state, we've had an average of 3,640. In 2013, we were at 7,900. So it's went up a lot. And if anything, what we're hearing now, moving into 2014, is that this is probably stabilized some. Some people say it may have come down a little bit, maybe gone up a little bit, but generally just stabilized. We haven't seen large drops. And frankly, I'm not that concerned about a large drop in farmland prices. And here's why. Let me just, what this blue line is the cash rent, average cash rent divided by the land value. So cash rent divided by land value gives you a sort of a return, average return. Here's the 10-year Treasury note. Here's when you were concerned about land values. The 10-year Treasury note was much higher than this. And the way you get this up here is drop farmland prices. If I drop farmland prices, this gets closer. All right? Here, we're still above what the 10-year Treasury notes returning. In my opinion, the bigger concern for farmland prices is probably not what's happening on the farm side, but what happens on the interest rate side. And right now, we have very low interest rates, and who knows what's going to happen, but the intent is to keep those low for a while. Fed, Janet Yellen, low possibly for a while. So, what that would likely mean from my perspective is that we're going to likely see slowing in growth rates in farmland prices because our rents are going to stop going up, probably. We don't see a bubble because if you look back, we don't see our returns and rents out of line compared to where they're at, and higher interest rates would be bad. All right. If you own land and you're thinking, well, maybe I should get out of this now, where would you put it? No, that's if you yeah, all right. So you agree, it may be high. Where would you put it? If you're going to spend it, that's fine. But if you're going to invest it, one thing to remember: if you sell it, you probably have a pretty good capital gains tax. And are you going to put it in a CD? You're going to put it in the stock market. All right. If you have money, where you want to, I still don't see farmland as a bad place to put it, particularly for a long run investment. If you need it in the next 5 years, no. But if you're thinking about this as something for your children or 20, 30 years down the road, it has been and will likely continue to be a good investment. So, I'm going to summarize. Cost and commodity prices down, and cost a little bit down, commodity prices down. We've seen comparable share rent and cash rent. And overall, we're just sort of moving into a lower return environment. When we look back over time, there's several golden ages in agriculture. The 70s, 50s, the 1910s. 2010, 2011, 2012 are going to be a golden age in agriculture, and now we're moving back to reality. All right, so it's just, the world's not falling apart, we're just going back to what's the matter? It's not, it shouldn't be as profitable as it was in 2010, 2011, and 2012. Let me back up a couple steps. So if you have a trust, you can hire a farm manager to manage that trust, and that farm manager will most likely be in charge of your individual marketings on that. So if you have a trust and land in the trust, 50-50 share rent arrangement, you have a farm manager, they will market the grain. They will market the grain. That won't be the farm owner's responsibility. In fact, that's part of the reason to have a farm manager. I do not know what the lawyer is saying about the fiduciary responsibility, other than my guess, and this is just my guess, if you have a trust, you likely have more people involved.
Right.
And I don't know if it depends on the relationships of the other people, but they can say that you're doing your fiduciary responsibility, whereas that individual, the farm manager, is a professional. You can argue with the results afterwards, but they've done the best that they can, whereas it gets more personal. So, all right, so let's say you're switching from cash rent to share rent. All right, so now, often what happens if you switch from the cash to share rent, there's a couple things going to happen cash flow wise that you probably want to be aware of. So cash rent, you receive a payment usually in April, and then at harvest, maybe one payment. If you go to share rent, often, most of the time, the landowner will begin paying fertilizer, seed, and chemical costs, which are due before harvest. So you begin paying those seed costs in the fall. Fertilizer's been put down for 2014 in the fall. So somewhere the farmer likely put that on. You'll get the bill, you'll pay it. At harvest, generally, the farmer you will receive the grain, and it'll be positive, I don't know, it will be delivered to a mutually agreed site. That grain will be in the name of the landowner. Half the grain will be in your name. Farmer will keep half, the landowner will get half. Then if the farmer's not going to market it unless you ask him to. And then all right, and here's my advice. If you ask the farmer to market the grain for you, just take what he does, because he's sitting there with the same advice. You can't, I mean, he's going to try and do the best, or he or she, but things happen. I mean, it's marketing. It's hard. And you know, this is the thing about share rental arrangements. Cash rent, you know, you've agreed on the rent and you'll get it. Share rent, I mean, this is agriculture, and sometimes the yields are there and sometimes they're not. The one thing that I wanted to mention this, if you're in a share rent arrangement, you can buy crop insurance, and I would suggest you do that. You're a separate policy from the farmer, but I would suggest that you do that.